We know the basic components of the statement of cash flow, how it's made up, what we need to get there. Let's go ahead and start preparing one. So the statement of cash flows is going to start with your traditional 3-line heading. So again, from what we were looking at earlier, we're doing our statement of cash flows for Boswell Corporation here for the year ended December 31st, 2016. So it'll start with that heading, Boswell Corporation, statement of cash flows, year ended December 31st, 2016. Within the statement of cash flows, each section of the statement of cash flows starts identically, with one word differing, and that is the section that it is. So the first section is the operating activity section of the statement of cash flows. So we'll start with cash flows from operating activities. This line, again, it's identical for each statement of the statement of cash flows. So in the next section, it would start with cash flows from investing activities. The third section would start cash flows from financing activities. Now, within our cash flows from operating activities, as we saw previously, the operating activity section is going to include everything from the income statement, as well as changes in current assets and current liabilities from the balance sheet. Now, on our statement of cash flows within our operating activity section, there are two acceptable methods for preparing the operating activity section. Good news for us is we're only responsible for knowing one of them. The one of them that we're responsible for knowing is the indirect method. The indirect method is easier, although it doesn't always make perfect sense when you're looking at it. But in the end, it comes out with the same number as the direct method does. To prepare the statement of cash flows using the indirect method for operating activities, we're just going to follow 3 simple steps. Step 1, start with net income. That's our beginning of the operating activities section every single time with the indirect method. So the first thing that I'll see is net income. And again, remember, we pull net income right off of the income statement. So the income statement told us that net income was 302. This being the first number in this column, I'll put a $ sign with it. Step 2. Step 2 and Step 3 are both adjustments that we're going to need to make to that net income number. So essentially with the indirect method, what we're doing is we're trying to take net income in total, this whole number of net income, and we're trying to say, all right, here's what net income was. Now let's change it into a cash number. So the way that we change it into a cash number is by doing Step 2 and Step 3 here. Step 2, adjust for any non-cash items from your income statement. Adjust for any non-cash items from your income statement. What we mean by non-cash items is literally that, something on the income statement that does not and will not ever involve cash. So as I look through the statement of cash flows, as I look through the income statement, what I really want to think about is, does this item at some point result in cash? Sales, absolutely. We're going to collect cash from those customers. Cost of goods sold, yes, we got to pay cash for that inventory. Gross profit's just a subtotal. Operating expenses, just a title. Depreciation expense. Every single time we've recorded depreciation expense, we've debited depreciation expense, and we've credited accumulated depreciation. There was never a point in time where you paid cash for depreciation, and there never will be. Depreciation expense is what's considered a non-cash item. So when we're talking about these non-cash items, we're specifically talking about depreciation expense as one, as well as those things that are kind of like depreciation expense, and that would be depletion expense if you saw it. We deplete those natural resources, as well as amortization expense, if you would see that one. We amortize those intangible assets. All right, so depreciation expense, depletion expense, amortization expense, those are all examples of what we consider to be non-cash income statement items. All right, so over here in my statement, the line that I use here is just standard language. It says adjustments to reconcile net income to net cash provided by operating activities. It's just telling the reader that we're about to make some adjustments to that net income number. So as we saw, Step 2 was, the first thing we wanted to adjust for were those non-cash income statement items, specifically depreciation expense. All right, now, When I'm adjusting for depreciation expense, this is a little bit tricky for some people initially. So when I'm adjusting for depreciation expense, what I really want to think about is, what did I do with depreciation expense on the income statement to get to net income? All right, expenses, depreciation expense, just like every other expense that's on here. Expenses, we subtract those from our revenues to get net income. So this depreciation expense, this $81 here, was subtracted to get to this 302. So if I'm now trying to remove it or adjust it out of net income, I've got to do the opposite. So with depreciation expense, I'm going to add it back in. Again, because it was subtracted to figure out that 302, and the purpose of what I'm doing with it here is to remove it from net income. So if I'm trying to remove it out of there, I just got to do the opposite of what I would have initially done with it. I initially subtracted it, now I got to add it back in. All right, our next step here. I'll call it step 3. So we're going to do 4 steps here, right? So step 3 is going to be some more income statement item adjustments. I'm going to say we're going to adjust for any non-operating income statement items. Non-operating income statement items. So what I'm referring to when I say non-operating income statement items, I am specifically referring to any sort of gains or losses that we see on our income statement. Gains or losses. So if I have a gain or a loss, let's say for example, I sold a piece of land and I have a loss on sale of land. That loss on sale of land is part of, because it would be on the income statement, it would be part of this net income number. Now, I know from what I did previously that if I sold land, the amount of cash I receive for selling land does not go in the operating activity section. All right, and the loss on sale of land, as we'll see in a little while, affects the amount of cash that I received for selling it. Therefore, if I leave the loss on sale of land as part of net income, and then I use it to calculate how much cash I got for selling that land as part of investing activities, I've used that loss on sale of land twice, and my statement of cash flows isn't going to balance out. And that's true of any gains or losses that I see on my income statement. So what I have to do with those gains and losses, just like with depreciation expense, is I have to do the opposite of what I did with them in the income statement. So if there was a loss on sale of land here in this income statement, I would add that loss back in on my statement of cash flows. If there was a gain on sale of equipment, I would subtract that gain out on my statement of cash flows in the operating activities, thus removing it from net income. I don't have any gains or losses this time, so I know that I'm okay. I'm okay to move on. So step 3, I could check off step 3. I did that as well. All right, so now I just have one more step here, step 4. And step 4 says that I need to adjust for any changes in current assets and current liabilities. Adjust for any changes in current assets and current liabilities. All right, so I'm going to teach you a little trick. All right, this little trick is not in your textbook, so this will be the first time that you get to see it. Essentially, what I'm trying to say here, I'm going to use this giant T account that I have here, right? And with this giant T account, what I'm going to do is I'm going to set it up just like our accounting equation. So if we remember back to accounting 1, our accounting equation said that assets equal liabilities plus owner's equity. All right? What I'm going to do is I'm just going to pull cash out of that equation, and I'm going to have it reported separately. So what I'm really saying is cash plus any other assets that I have, we're going to set that equal to liabilities plus equity. There we go. All right, so I have an accounting equation here. All right, cash plus any other assets that I have are equal to liabilities plus equity. Now, any change in a current asset or a current liability. All right, so I know I had 4 of them that I needed to take care of: accounts receivable, inventory, accounts payable, and income tax payable. What I'm saying here in the statement of cash flows is those changes also impacted cash. The easiest way to see that impact on cash is really to apply them to this nice little accounting equation here. All right, so let me start with accounts receivable. Accounts receivable began the year, or ended last year, with 122 and ended this year with 140, which means accounts receivable went up by 18. All right, so let me think about this. All right, so if accounts receivable went up by 18, I know that accounts receivable is an asset, right? So I'm going to put accounts receivable in that other asset category here. So those other assets went up by 18. Okay, so if my equation has to stay in balance here, and I'm saying each one of these things affects cash, well, I don't have anything on this side of the equation, no liabilities and no equity. So in order for my equation to stay in balance, cash is going to have to go down by 18. Cash would have to go down by 18 in order for this to work. So over here on this side, I'll see a negative 18 in cash. whatever happens here in this column, that's what I'll pull over to my statement of cash flows. So here in my statement, I will say increase in accounts receivable. And then I will put in the effect that I just showed right here in my giant T account, minus 18. And I've now showed the effect of increasing accounts receivable. All right, I could check off accounts receivable. What I'm going to do is I'm going to highlight it. All right, so I'm going to show accounts receivable as a highlight because I just took care of that one. And remember, like I said, before we're done, we should be able to highlight or check off every single one of these things to show how they impacted cash. All right, so I'm going to do inventory next. Same thing. So let's look at inventory here. Inventory started with 801. It ended with 914, which means inventory increased by 113. Inventory, well, I know inventory is an asset as well. So that asset went up by 113. We don't have anything over here on this side of the equation, so that means in order to get to 0 on this side of the equation, cash is going to have to go down by 113. So I'm going to see that same negative effect on cash here because of the increase in inventory. Again, whatever happens to cash here, that's what I pull into my statement of cash flows. So I say there was an increase in merchandise inventory. Because there was that increase in inventory, cash went down by 113. All right, I can check off merchandise inventory. Highlighted, I just took care of that one. Down to my liabilities. Accounts payable. Started at 144, it went down to 104. So accounts payable decreased. Okay, so I know accounts payable is a liability here, right? So accounts payable, one more time, accounts payable went down by 40. All right, so I'll see this negative 40 over here in accounts payable. All right, accounts payable went down by 40. Now this one, let's got to think about this one a little bit differently because remember up here, we had 0 on this side of the equation, but now I have negative 40 on this side of the equation. So to make my equation balance out, that means I need negative 40 on this side of the equation too. So because accounts payable went down by 40, for my equation to stay in balance, cash is going to have to go down by 40 as well. Now I have negative 40 on this side of the equation. I got negative 40 on that side of the equation. So that's what I'll put here into my statement. Decrease in accounts payable. That's what happened. The effect on cash, what I pulled from that cash column, is cash went down by 40. All right, one more to look at. I can check off accounts payable because I just took care of that one. Income tax payable went up. Started at 36, ended at 41. So income tax payable increased by 5. Okay, so income tax payable is a liability again. So if that income tax payable went up by 5, I'll see that plus 5 over here in liabilities. Again, I got to think about this one the same way. I have plus 5 over here on the right side of the equation. What's got to happen to cash in order for my equation to stay in balance? It's got to go up by 5 as well. All right, so I'll have to see that same plus 5 over here in cash. So cash, because that liability went up, cash went up as well. So here in my statement, I'll say increase in income tax payable, and I put the effect of cash, which was a positive 5. I can check off income tax payable to show that I'm done. Highlight it, and we are good to go. All right, I have now made it through all of my current assets and my current liabilities. I know I made it through the whole income statement because I started with the bottom line total from that income statement. That means I should be done with my operating activity section. I just got to do a couple of things to finish it out. All right, first thing I'm going to do, I'm going to total this up. So I want a total of all these adjustments that I'm making to net income. All right, so I totaled it up. So what I'm saying with this number right here is, in order for my net income number to become a net cash number, I need to subtract 85 from it. So that's what I do. I say net income. I take out 85, subtract 85 from it, and I'm left with 217. All right, because that's a positive, I will say that net cash provided by operating activities equals $217. That's it for the operating activities. We're ready to move on to investing activities next.